I get to talk to people all day, every day about property, how to best grow and develop a property portfolio. And a part of that, I get to genuinely listen to what people's biggest fears and concerns are. Is now the right time to invest? Aren't we heading into a recession? Builders are going bust everywhere. The market is falling and so on. And I get it. You turn on the news and there are attention-grabbing headlines everywhere, telling us about the doom and gloom one day, and then literally another day saying the worst is all behind us and it's all rainbows and daisies. So if this is all you see, no wonder there's a ton of confusion and uncertainty. Now, I'm not an economist or some fancy guru that claims to predict the future of the property market. But what I can tell you is that I've been through a few cycles now, and I've seen all of this happen before. You start to notice patterns. You then learn to not only protect yourself, but how you can also spot opportunity that comes in these times. Now, I personally got just over $14 million in debt across my portfolio. I've got 10 projects that are currently in my development pipeline. And I tell you this not to brag or come across like a douchebag, but rather to show you that I have my personal money where my mouth is. So this is what I'm predicting will happen in the property market and how I am personally preparing my portfolio. Now, no matter what happens, before I look at any other opportunities, I always look internally at my existing portfolio. I look for any financial inefficiencies and things that I could do better. When was the last time you had a rental review on any of your properties? Have a look at the interest rates that you're paying with all of the banks. Can you get a better deal? Speak to your property manager. Are you getting charged the adequate property management fees? Same thing with insurances. It is worth shopping around. I can tell you this, the quickest way to make money is to save any financial inefficiencies that you already have. I then take a good hard look at my personal budget. I plan for the worst and I hope for the best. Life happens, and it would be naive to think that everything always goes according to plan. So it's so important that you have rainy day money set aside. We call them buffers, and buffers can be broken down into three things: your personal buffer, your property buffer, and your income buffer as well. Your personal buffer should be set aside for things like holidays or school fees, or if you need to upgrade your vehicle, things like that. The property buffer should be set aside just in case any expenses pop up with your property. If interest rates go up and rents don't, you need to make sure that you have adequate funds to maintain the property as it keeps going. And your income buffer, well, that's in case anything should happen to your income, whether it's your job or your business. My personal strategy is to never buy another acquisition until my total portfolio completely looks after itself, unreliant on my income. Your strategy may be different though, so it's so important to make sure that you keep adequate buffers in place, because you never ever want to be in a position where you are forced to sell your properties. I then assess what my finance capacity is across a multitude of different lenders. At the end of the day, unless you're lucky enough to pay cash for a property, you need to keep the banks happy. And let me stress, I never go to one bank directly or one financial institution directly. I always use a qualified mortgage broker that has experience in building multi-property portfolios. So I check what is my capacity to invest in a house project, as well as what's my capacity to invest in a duplex project. And the reason that these two numbers are different is because of the projected rental income that we can use. Typically speaking, duplexes produce a lot more rent than housing acquisitions. So I want to see exactly what's possible for each type of acquisition. If my capacity is struggling in any way, shape or form, I then have a look at my existing portfolio and go, well, which property am I potentially happy to take profit off the table, use the proceeds to pay down debt to then free up borrowing capacity? And let me stress, because this is super, super important. You never want to sell a property unnecessarily. But in the same respect, you never want to become stuck like your typical retail investors, whose only form of success is to buy, hope and pray that their portfolio will go up over the longer term. We want to get more active and we want to generate the results a lot quicker. So again, I run those scenarios. I also ask my mortgage broker to have a look at my equity position. When was the last time that you had your properties valued from a bank's perspective? I always check that because I never want to have lazy equity sitting in my portfolio not working for me. Now, one thing I've learned in more recent times, which is super cool, is I also run the scenarios if I was to invest in a property outside of the existing entities that I have. So, Mr. Broker, what would my capacity be if I invested in my personal name? What would my capacity be if I invested in a company? What would my capacity be if I invested in a trust structure? All of these scenarios we need to run to see exactly what's possible for you. Because at the end of the day, if you can't get the finance, you can't grow a property portfolio. It's now time to set up and lock in your strategy. And for me, this is the fun and easy part because my strategy is always the same. It's to try and generate as much equity as quickly as possible so that at completion, I have options. Those options are A, do you get the property revalued? Use the equity that you've generated to then roll into your next project and keep moving your portfolio forward. Or option B, do you take profit off the table? Use the proceeds that you've made to pay down debt and then redeploy the capital to keep growing and moving forward. The last thing you ever want to do is become stuck like your typical retail investor, where your only form of success is to buy, hope, and pray that you made the right decision, only to sometimes find out decades later that you've bought an absolute lemon. So my strategy is all about finding opportunities that are under market value, that you can add value to through doing small developments to give you these options. Drew, get to the point, I hear you saying. How do you protect yourself in these times? And better yet, how do you prosper? Well, I've already given you the answer. The answer is it lies in your strategy and the types of property that you acquire. Number one, you should never ever pay full retail price for a property where your only form of success is to buy, hope, and pray that you've made the right decision. You should always invest in real estate that has an equity uplift right from get-go. My latest acquisition was a duplex, and I paid $1,230,000 for it. Now, at the time of acquisition, comparable duplex halves were selling for $800,000 a side. That gives us a gross realization of $1.6 million. If you take away the initial acquisition price, there is a gross equity uplift of $370,000 on this project. So the market has to drop by $370,000 for the property to be worth what I actually paid for it. Number two, you should never get in a position where you are forced to sell your property. Again, even if the market did drop by $370,000, I don't have to sell the property because the rental income that I get on this project is $1,100 a week, will cover all of its costs, and my portfolio is completely reliant on its own rental income. Number three is you should invest in real estate that pays you to own it, not that ties you further and further to your job or further and further to your business to make up any of the shortfalls. And this is a huge mistake that I see people making. It's buying the wrong type of real estate right from get-go. Drew, what happens if rates keep going up? Well, my response is the interest rate cycle is just that. It's a cycle. They go up and they go down. However, if you have properties located in the right areas with minimal vacancy that are well located and in high demand, as interest rates continue to go up, so too should the rent that you're able to charge for your properties. I genuinely believe that we're in amongst a huge rental affordability crisis. In fact, I was having a chat to one of my staff members who's been looking for a rental themselves. And they said, Drew, I've been looking for the last 3 or 4 months, and every open home inspection I turn up to, there's 20 to 30 people looking at the same property. So it is incredibly hard out there. But here's the thing. What happens when interest rates start to come back down? Do you think that the rent is going to decrease too? Something to think about. In fact, jump onto the ASX website and have a look at the 30-day cash rate futures implied yield curve. This futures market implies that the interest rate is due to come back down towards Christmas this year. And what do you think is going to happen in the property market if interest rates start to come back down again? I agree. I think it's going to spur the next property boom. So I'm positioning myself perfectly today to take advantage of that. So as interest rates continue to go up, you can always put your rents up too if they are well located. But if you can't put your rents up, you should also have built in your property buffer. So you should have adequate funds aside to make sure that you can afford the interest rates as they go up. But Drew, I'm scared of building. Every time I turn on the news, I see builders and building companies going bust and going out of business. And that's true. The sad reality of the pandemic is it has impacted the building industry. And I believe a lot more builders and companies are going to go into liquidation in the coming months. However, we spend a lot of time, effort, and research by hand selecting the builders that we deal with. In fact, we've been building with our network for the past 10 years. So we know that they have a proven track record. We know the quality of build that they do and the level of inclusion that they build to as well. We also know that they agree to our development terms on a retail basis. For example, the builders that we work with, they agree to fixed price contract for 6 to 12 months from the date that they issue the build contract. So if the builder hits rock, that's their problem. If the cost of materials go up, that's their problem. If the cost of labor goes up, that's their problem too. We also know that the builders agree to full liquidated damages. So once all the plans are approved and the builder gets to site, if they don't deliver you a house in 22 weeks or a duplex in 29 weeks, the builder is liable for the full liquidated damages, which we negotiate at the full market rent. Not a lot of builders will do that. We also know that the builders that we work with are financial. They get the regulatory bodies to come through their books every quarter to make sure that they are trading profitably and that they have the adequate insurances in place. We also know that the builders have a vested interest in keeping all of our clients happy, keeping myself and Damien happy, because if they don't, they then don't get the next 10 jobs. So we've really created this win-win scenario for everybody involved. And lastly, I personally use the exact same builders that we recommend to our clients. In fact, the last 10 projects that I've done, are the same builders that we've used for our clients as well. But ask yourself this question. If there is a lack of building going on in the areas that we're investing in, what do you think that's going to do to the value of the properties that are getting built? But Drew, what about the talk of the slowing economy, the high inflation numbers, and the possible recession? And to be honest, I keep it super simple on this point. And my simple analogy is this. We all need shelter. We all need a roof over our head. And in my opinion, the bigwigs in Canberra have been making the wrong policy decisions. They have not allowed for enough supply to meet the demand of accommodation that we need in this country. And again, it's going to get worse. Think about it. We now have record amounts of people wanting to move to this country as a result of COVID. So our population growth has never been stronger. Yet the supply of new housing that we have is still very, very low. And this is what's exacerbating the problem of the rental affordability crisis and, of course, the skyrocketing housing prices as well. In terms of the economy, the unemployment rate is sitting at a staggering 3.5%. And I can tell you as an employer how hard it is to find good quality people to come and work for us. Inflation, yes, the numbers did go a lot higher, but they're starting to slow down now. I grew up in Zimbabwe in a hyperinflationary environment. So I've seen firsthand exactly what the debasement of a currency does. And my advice is this. You always want to invest your money as an inflation hedge in income producing assets. And for me, the best way to do that is obviously in real estate. Think about it. I don't have staff members coming to me saying, hey, Drew, please pay me less money. Now, extrapolate that across the whole housing industry. Your Section 94 contribution is getting more expensive. Your cost of material is getting more expensive. The labor is getting more expensive. Everything simply is getting more and more expensive to produce. So again, I don't think inflation is going to go through the roof, but if it does, the hedge for me is to invest in income producing assets as a result. Now, all of this stuff I can't control, but this is what I can control. I can control my household economy. How much money am I spending? How much debt do I have? What does my household cash flow look like? These are the things that I can personally focus on. And again, that ties into my overall strategy. I focus on what I can control because I know the things that I can't, I'm not personally going to have an impact anyway. But this is what I can tell you. What happens if the economy doesn't slow down? What happens if we don't have significant inflation? What happens if we don't go into a recession? I want to position myself perfectly for when the times get good again. And that's Warren Buffett's favorite saying. When others are greedy, be fearful. And when others are fearful, be greedy. So to summarize, this is what I'm personally doing to protect myself in these times, but also to massively set myself up to profit from them. I focus on what I can control, not on what I can't. I can't control what interest rates are going to do, what the inflation numbers are going to do, what the general economy is going to do. But what I can control is my specific household economy. What are my cash flows? What are the buffers that I set in play? What is the specific strategy that I choose to adopt? And that strategy is all about finding opportunities that are under market value, that you can add value to so that on completion, you have an equity uplift. And it's that equity uplift that gives you options. You can use the equity you've generated to roll into your next project and keep building up your pipeline. Or you can sell down the project, use the proceeds to pay down debt, which frees up borrowing capacity to allow you to keep building your portfolio. The last thing I ever want to be as an investor is stuck. And unfortunately, that's the biggest mistake your typical retail investors make. I invest in real estate that pays me to own it, not the other way around. The worst thing is to be tied further and further to your job or further and further to your business just to keep your property portfolio going. I also believe that there are some phenomenal opportunities in the marketplace at the moment. And for me personally, I would much prefer to secure my acquisitions when there's a lot of doom, gloom, and uncertainty in the marketplace, as opposed to when the market is absolutely booming. Because as we all know, when markets are booming, that's when everybody gets caught up in the hype and overpays for their acquisitions. Guys, I hope you found this little video helpful. As always, it's just my opinion. What I do is I do run an automatic equity program that teaches you exactly how to profit from these times. It's an application process where we don't take on everybody. I need to show you that we can add a huge amount of value to your bottom line, and you need to show us that you can afford the opportunities that we have. Otherwise, it's a waste of money for you, and to be honest, it's a waste of time for the both of us. So essentially, it is completely obligation-free. I'd love to show you exactly how I'm doing it and how we too can help you as well. Click on the link below, and I'd love to see you on the inside. Chat to you soon.